It's Friday, 6th of March, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, war in the Middle East and implications for energy markets. But first, Group Chief Economist Neil Shearing is with me to wade through an extraordinary week in global macro and markets. Hi, Neil.
Hi, David. We say it every week, but
I know.
Literally, we had war and now we've got that payrolls number. I don't want to conflate war and payrolls, but it's just like, will this stop at some point?
I've said extraordinary. I've run out of adjectives at this point. We've got Brent crude just over $90 now, European natural gas near 52. We are just shy of a week since this conflict started with those US and Israeli strikes on Iran. As you suggest, it does feel like we're giving a weather forecast standing in the middle of a hurricane. But when we think about global macro, how do we process all that's going on, with particular focus, obviously, on events in the Middle East?
I think the first thing to say is that the Gulf economies and the Middle East itself is facing a pretty substantial economic shock. It's not implausible that GDP in countries like Israel or some parts of the Gulf could contract by 1% in this quarter as a result of this conflict. Of course, Iran's economy is likely to be hit even harder. Yet, a bit of context too, the region is about 2 to 3% of global GDP. So clearly the spillovers in a direct sense to the rest of the world are pretty limited. Of course, the most important transmission mechanism is through what the region sends to the rest of the world, in particular through energy markets, not just oil, but natural gas too. And particularly the extent to which the Strait of Hormuz remains effectively closed. That carries about 1/4 of all seaborne oil shipments in the world. About 1/5 of all seaborne LNG flows in the world go through the strait. So clearly, the extent to which the strait remains effectively closed, that's restricted supply, that's pushing up on prices. As the strait remains closed and the Gulf economies can't get shipments out, they're also running out of storage too. So that's causing them to contemplate slowing production, even shutting down production in some cases, which is adding to supply concerns. That's pushing up prices. The transmission mechanism through the global economy is through what economists call the terms of trade. Effectively, that's how the price of your imports shift relative to the price of your exports. What this is really doing, of course, is shifting income from energy consumers to energy producers. So if you're an energy producer outside of the Gulf, you can continue to send your shipments across the world, then you're one of the winners in all of this. Russia, Canada, Norway, the three big winners. If you're a major net energy importer, then you're one of the losers. The world's largest net energy importers are principally in Asia, as a share of GDP, Korea, Japan, but also India and China, and of course in Europe. The channels to energy, Europe and Asia are the main losers. There's a handful of winners like Norway, Canada, Russia. The US is somewhere in the middle. It is broadly awash now that its energy balance is effectively zero. In terms of the economic scale and the impact, it's all about the price moves and the duration, crucially the duration. At this stage, we're not anticipating major economic dislocation from this crisis, but clearly if there's to be a much bigger move in energy markets, or that was to intensify over the coming weeks and months, then the economic cost could increase.
As I say, I'm looking at the chart now, your Brent crude over $90. When we're thinking about duration, at what point does this become really problematic for the inflation outlook, for the global demand outlook?
Well, Brent crude over 90, if you look at it, natural gas prices have actually edged down a bit today on Friday as we're speaking. And of course, those moves have been nowhere near as violent as they were after Russia's full-scale invasion of Ukraine in 2022. And that's a really important part of the pass-through to inflation, particularly in Europe and Asia. So it's not just oil, it's natural gas too. Now, broad rule of thumb, if oil prices are in the $80 to $90 a barrel range and natural gas prices stay around 50 euros per megawatt hour, that will push up inflation in developed markets by about 0.3 to 0.4 percentage points relative to a baseline in which prices were unchanged at, say, end February levels. Clearly, the increase is going to be much larger in Europe and Asia than they would be in the US. In a more extreme scenario where the conflict continues to roll on, energy prices rise even further, say to $100 a barrel for Brent crude, 100 euros per megawatt hour for European natural gas, well, that would add about 1 percentage point to developed markets inflation relative to the same baseline where prices were unchanged at the end of February's levels. And in Europe, the increase would be more like 1.5 percentage points. I think in that case, we would have more of a more significant hit to real GDP growth in advanced economies, perhaps nudging it lower by 0.25 to 0.5 percentage points relative to our pre-conflict baseline, something like that. And again, Asia, Europe hit harder than the US.
So we're less than a couple of weeks away from the next round of big central bank decisions. With all that you've said, it doesn't sound like this is going to have an immediate influence on near-term decision-making. It doesn't sound like central banks are going to react quickly to anything that's going on. How do we think about the impact that moves in energy prices that we've seen over the past week? How does that feed through to central bank decision-making?
The policymakers that we've heard from over the past week have essentially said exactly that, the point you've just made, that it's too soon to say exactly what impact this is going to have on inflation or economic growth, and it's too soon to say how policy might adjust accordingly. So essentially, it's too soon to say in their eyes. I mean, normally, in normal circumstances, you would expect central banks to so-called look through energy inflation shocks. There's nothing that monetary policy can do to really influence how energy prices, food prices too for that matter, move, because they're setting global markets. So central banks tend to look through energy shocks, food shocks, and commodity shocks and focus instead on core inflation. In this case, though, in some countries where inflation is still either high or labour markets are tight or inflation expectations are relatively high, there might be more of a case for central banks responding. I'm thinking in particular of the UK, where inflation is still above target, inflation expectations are relatively high. Now, when I say respond, I don't mean by hiking interest rates. I think the bar to rate hikes is pretty high across advanced economies. But in the case of the UK, it wouldn't be a surprise to see the Bank of England slow the pace of easing in response to the energy price shock caused by the conflict. If it were to persist, as I say, it's still a bit too soon to say, but I think at this stage, it's more likely that to the extent there's any implication for monetary policy, it's more likely that it's to slow the pace of planned easing rather than for central banks to rush out and hike interest rates. I don't think that's likely to be the response. I think one important point to make is that we've had a lot of questions about how the current situation compares to the situation in 2022, when, of course, Europe faced an enormous energy shock after Russia's invasion of Ukraine. Lots of similarities and many differences too, but one of the important differences is that back then labour markets were not only relatively tight, but also monetary policy was also extremely accommodative. Interest rates at near zero levels. So clearly that's not the world that we're in now. Monetary policy broadly at a neutral setting. So if you're a central bank, you can afford to kind of step back and wait and see, if you like.
Let's focus on the Fed, because you mentioned that payrolls report that's just come out less than an hour ago. The February payrolls down 92,000 is a big miss. I think the expectation was for something like a 60,000 gain. But it is just one report, important to note that. But it is part of a bigger patchwork of data that have been coming out about the US. So how does this payroll then feed into that debate on the FOMC, particularly given that we're going to have a new Fed chair coming in just a few months?
Yes, the usual health warning attached to all payrolls numbers. I say it every month. Essentially, the payrolls numbers, it's something akin to a random number generator. Very often the markets fixate on the number. There's enormous market moves to shifts in the data that are well within the margins of error. Now, in February's employment report, that 92,000 decline in payroll employment, I think, is significant. And it does reveal some labour market weakness. But bear in mind that some of that weakness is perhaps due to striking healthcare workers in California and Hawaii that will get added back in once those strikes are over in subsequent months. Also worth noting that there wasn't much of a pickup in the unemployment rate, only went from 4.3 to 4.4%. The average weekly earnings number actually picked up too. And some of the survey data that we've had for February has been relatively good. They point to actually a strengthening in some of the labour market conditions in some of the business surveys. So take all of that together. I don't think the labour market is quite as weak as that headline 92,000 decline in payroll employment in February suggests, nor do I think it was ever as strong as the 126,000 gain that we had in January. So it's probably somewhere in the middle. Labour market conditions cooling, not collapsing. If you're the Fed and you have core PCE inflation rising back above 3%, you've got global energy prices surging, and you've got a labour market that's cooling but not collapsing, I don't think you're in a rush to loosen monetary policy. At least that would be my read.
So just to pull it all together, yes, your energy prices surging, that's something that's going to potentially weigh on inflation, on growth, but it's all dependent on how long this war lasts. Central bankers not going to move for now. Perhaps down the line, it could slow the pace of easing or maybe convince some central bankers to stop easing altogether. But pulling it all together, it does feel like the balance of risks facing the global economy have turned sharply negative this week relative to what we were expecting coming into 2026.
I think they've certainly turned negative. I'm not so sure I'd say sharply negative. It really depends upon how the duration of the conflict, and as I said at the top, the impact on global energy markets. It has the potential to be substantially negative if the conflict escalates and persists. But equally, if over the next week or so the conflict starts to fade and energy prices start to fall back, then I think the economic implications, the economic consequences might be smaller than many currently seem to expect, particularly in countries like the US. Likewise, lots of lurid headlines around the impact that AI is having on the jobs market. But as I said earlier, we've had a 1 month week payrolls number, but some strong survey data. And yes, the US consumer seems to have got off to a slightly softer start to 2026, but that's coming off the back of a pretty strong second half of 2025. So I would still say that on balance, the global economy is muddling through. Clearly, things have become much more difficult. Clearly, the balance of risks have shifted and downside risks have increased. But at this stage, I think we're more likely to kind of muddle through rather than being on the cusp of a very sharp slowdown.
Before you go, I did want to ask you, because we spoke last week ahead of the National People's Congress in Beijing, the release of growth targets for 2026 by the Chinese government, the release of the priorities of the latest 5-year plan, the 15th 5-year plan. We were talking about the potential for China to make a stronger move to boost consumption, to rebalance the economy. You had a note out that went out midweek, just ahead of the start of the NPC. It was titled, "Will China Finally Pass Its Big Rebalancing Test?" So did it pass its rebalancing test?
I think at this stage, we'll give it a C-. There was something for those that were looking for, that are perhaps expected some rebalancing, insofar as it looks like fiscal policy might be a bit looser this year once we've kind of picked through the various budgets and off-balance sheet vehicles. But that's about it. There's nothing in the documents, the associated documents, so far as we can tell, that really signal a concerted effort either to raise and reinvigorate domestic demand, and in particular to shift the balance within domestic demand from investment to consumption. That's the key internal imbalance within China's economy. So yes, anyone that was banking on the wholesale reform in China and a concerted effort towards rebalancing, I think has been disappointed this week.
Neil Shearing there on Chinese reform, on US payrolls, and of course the macro and market implications of fresh conflict in the Middle East. We do have a page on our website that houses all of our key insight into this crisis. I will link to that in the podcast notes. Regardless of your focus, it's times like this that you want the fullest possible picture of what's happening in the global economy, in commodity markets, in financial markets. We do have all-access subscription packages for our platform. It gives you access to all our written analysis, to our online briefings, to our data tools, and much more besides. Drop me a line at capitaleconomics.com if you'd like to learn more, and we could set you up with trial access. Now, as Neil described it, the main channel to watch in this conflict is the energy market, and to find out what's next, I caught up with Kieran Tompkins, who is a senior commodities economist here at Capital Economics. Worth pointing out that when we were talking, Brent crude was at $80 a barrel, and the US Treasury Department hadn't yet announced those loosened restrictions on access to Russian oil, including for India. Anyway, here is that chat now. Briefing clients throughout the week on what's been happening in the Middle East, what's been happening with Iran. Unsurprisingly, most questions center on what's been happening in energy markets, because that's how we see growth. If it is affected, that's the channel through which it's going to be affected. That's how inflation would go off track. Ultimately, that's where central banks would have to change tack. So I thought for this conversation, it would be useful to address some of those frequently asked questions that have been coming in over the past few days, and maybe highlight one or two of the more interesting ones. But first, I just want to timestamp this because of just how fluid the situation is. So we are talking about 3:30 London time on Thursday. That's 10:30 in the morning, New York. As of now, what do we know about the extent of supply disruptions? How disrupted is the energy market?
Starting with natural gas supplies, we had the announcement earlier in the week from Qatar Energy that it's halted its output and exports of LNG. So for some context, Qatar is the world's second largest exporter of LNG. It accounts for about 20% of global LNG trade. And on top of that, they've also warned that in terms of returning that output when it is possible, that it will take a couple of weeks to return that output once it has decided to, and then another couple of weeks again to get back to full production and export capacity. In the oil market, the hits to production haven't quite fully crystallized yet, as they have done with natural gas supplies. But the longer the crisis does draw on, the more likely it is to do so. More specifically, explaining through the mechanism of this, while producers can't export their oil, their available storage facilities in the region are filling up very quickly. And once those storage facilities are full, at that point, it forces production to be shut in, and global oil production starts to take a major hit. Now, this has already begun to some extent. Iraq made an announcement earlier in the week that was being forced to shut in production worth 1.5 million barrels per day, so about 1.5% of global oil supplies. And it probably won't take long before other producers in the region are forced to make similar decisions over the course of the next few weeks and months. Admittedly, there are some options for Saudi Arabia and the UAE to divert some of their oil supplies. That said, there are limits on their abilities to do so, and we suspect somewhere in the region of 10 to 20% of global oil supplies may be trapped and vulnerable to a halt in production. But the important thing here is that the longer that production is shut in, the harder and more costly it becomes to restore, just due to the science behind producing oil. Means that output cannot be increased from zero to full capacity at an instant, and output can be permanently lost in some extreme cases too.
So even if there is a ceasefire, tomorrow, it's not as simple as just flicking a switch or just reopening the Strait of Hormuz and we're back to business. You're talking about weeks more of disruption for what sounds like a very sizable chunk of global energy.
Yeah, that's right. Crucially, these producers, at least in the oil market, would be able to tap into some of that storage they've got. But certainly for oil production in the region, it will take a little bit of time for normality to be restored.
The International Energy Agency, which is this supply overseer created in the early 1970s during the OPEC embargo, here they are now saying today that global oil could swing from surplus to deficit if this situation carries on. Now, we came into 2026, Capital Economics, warning that the supply glut in the oil market was only going to get worse, and that was reinforcing our $50 a barrel forecast. How would you frame the risk that we move from surplus to deficit? What would this mean for market? What would this mean for the price outlook?
I think some back-of-the-envelope calculations would really help to illustrate the situation we have here. So before this military conflict, we were forecasting an oil market surplus of about 3.5 million barrels per day in 2026, which would actually have been extremely large by historical standards too. Now, taking the middle of this range of supplies that could be trapped that I mentioned earlier, so about 15% of global oil supplies, that could wipe out this size of oil market surplus that we were anticipating within 3 months. And if that were the case, we would surely see higher prices endure for longer.
Talk a bit about the risks to prices. There were around $80 a barrel, Brent is. The Economist team have been talking about how macro risks from all of this really crystallize in the $90 to $100 range for a sustained period of time. So what could be a trigger for that happening?
Yeah, I think if we just take a step back, where prices haven't risen by more so far, possibly reflects investors sat in the middle ground, still pricing in a decent chance of a short conflict that doesn't have long-lasting effects. At least those attitudes also seem to have been reflected by movements in broader financial markets that we've seen over the course of this week as well. But in terms of what could trigger a move higher, I think it's this level of disruption lasting for longer, or we head for a situation where global oil supplies are lost as a result of these production shut-ins materializing. And I think there's another point here around the dynamics of not just how far prices could rise, but how long they could settle higher too. The shorter the disruption, the easier the transition back to normality for global oil production and trade. So prices could therefore fall back pretty quickly in that scenario. But the longer that this disruption goes on for, not only the higher that prices could rise in the first place, but that they could settle there for longer due to the effects of disruption lingering.
Is it a clear and present danger, the idea that we could be moving to a world of $100 a barrel oil?
If you can imagine the conflict essentially going on for a month, then I'd say yes.
As I say, we've been fielding questions from clients all week about this situation. The most frequently asked question is, what are the macro implications of sustained high energy prices? But the other question is, why can't oil and gas supplies just be sourced from alternative producers? How easy, how complicated is that?
So the US could feasibly increase output by a bit if oil prices stayed elevated for some time. So given the relatively short lead times for US shale projects, the US is in a position to react much more swiftly to changes in oil prices than most other producers in the world. And it's developed its reputation as an important swing producer in the global oil market as a result of this. But in practice, though, those kind of dynamics have become much more muted since the pandemic, as US oil producers have focused a lot more on capital discipline rather than trying to grow output at all costs. And so we don't think that US shale producers would jump at a spike in oil prices. I think there'd only be a meaningful supply response to this if it did become clear over the course of a few months that disruption to trade and production in the region was going to persist for a protracted period. There is some room elsewhere in the oil market to help cushion this impact. And that might have a lot to do with a potential softening in attitudes towards sanctioned Russian oil. It's been reported in the financial media that China has been increasing shipments of Russian crude and plans to expand these further. Meanwhile, it's also been reported that Indian refiners are considering importing more Russian crude as well. And Russia has contributed to a very large increase in crude oil stored on water as well. So it's quite feasible that they could draw down those stocks to any willing buyers pretty easily. And it wouldn't really be outside of the US's playbook to soften its stance on one sanctioned oil exporter in order to pursue foreign policy goals elsewhere, given that is exactly what it did, but in reverse during the Russia-Ukraine war.
But is that enough to make up the deficit caused by the disruptions in the Middle East?
No, it probably wouldn't fully offset it. It would probably only help to cushion the impact of it. And countries have some other tools up their sleeves too to help soften some of the impact. Specifically, members of the International Energy Agency are usually required to hold 90 days of net import cover of oil. So they could feasibly release those oil reserves too. And on top of that, China has been amassing a vast stockpile of oil in recent years by building new storage sites and purchasing very large scale of reserves. And estimates of the size of China's strategic and commercial oil reserves range somewhere between 1.1 and 1.4 billion barrels, which is about enough to cover somewhere between 95 to 120 days of net imports of crude oil for China.
And what about gas?
On the gas side, I think the potential for a sizable supply response from other countries is much more limited, not least because it is constrained by the size of existing LNG export infrastructure. Granted, LNG export capacity is set to increase significantly over the next few years, but that's not going to ease the upward price pressure that we're experiencing in the present situation. Again, the one area in the global LNG market where exports are below capacity is the Arctic LNG facility in Russia, which has been under sanctions since 2023. But once more, whether to ease the extent of this crisis by lifting sanctions will come down to a policy choice for Western governments.
We had a really interesting client question in a briefer yesterday about the long-term implications of this episode, how it will affect the market structurally. I know it's early days, but we talk about the International Energy Agency, the IEA. That's a consequence of the OPEC embargo of the early 1970s. That's one of the legacies of that episode. What do you think could be a potential legacy of this conflict that's happening now, either behaviorally or structurally within the market? Where do you see potential lasting changes?
I think one thing that this situation has laid bare is a problem around the concentration of supply and also nations' energy security for both global oil supplies and LNG trade. And for the most part, this isn't a problem while conditions are good and geopolitical risks are low, but become a very thorny issue when that isn't the case. In the LNG market, the backdrop is one in which there's going to be this large expansion in export capacity set to come online. That will be led by the US, who is already the largest producer, where they're set to increase export capacity by 50% by the end of this decade. But in essence, that's not really resolving a very core problem at the heart of all this, which is the concentration of supply among a few producers. So between the US, Qatar, and Australia, they together account for about 60% of global exports, LNG exports currently, and that share is set to rise further. For the US and Australia, the issues around shipping choke points that we're seeing right now in the Middle East aren't so relevant, but over-reliance on a single supplier shouldn't be taken for granted either, especially in the case of the US at the moment with such erratic policy making in the White House. It's certainly not out of the question of a weaponization of energy flows to supposed allies. Just look at the situation around Greenland not long ago, and also just this week, the use of threats to use trade policy against Spain as a punishment for not aiding the US's foreign policy goals in the Middle East. But as I said earlier, this is fundamentally an energy security scare. And when it comes to energy security, the solution to that is either a self-sufficiency of supply, which for many is not possible or simply uneconomic, or it's a diversity of supply, both in terms of fuels and providers. And as I touched on before, it's hard to develop this diversity of providers in the case of natural gas, where the supply is so concentrated. But that is probably where developing a diversity of fuels is important too. And renewables are probably a piece of this jigsaw in the energy security problem, in that, they provide part of the solution on both the diversity of fuels front, but also the self-sufficiency front too. However, they're not the silver bullet. They're not the entire solution, given, a base load power is also needed alongside renewables too.
I guess there's another scenario in which there is a ceasefire, or even that a regime emerges in Tehran that the US can do a deal with. And to your point, they do flick the switch, and after a few weeks, the disruption washes through. The oil flows again, and prices do what you've been forecasting they would do coming into 2026, where you do get $50 a barrel oil. and actually maybe nothing changes?
Yeah, in that case where the macroeconomic hit is much smaller, much more contained, maybe this situation doesn't live quite as long in the memory, and where for oil supplies there is a very inescapable problem that production, a key determinant of production, is around natural endowments of these and the economic incentives to develop them. And both of those are the strongest in the Middle East. So where if this crisis doesn't cause a large macroeconomic fallout, it could be back to business.
Kieran Tompkins on an historic disruption to energy supply. Kieran will be briefing clients along with the rest of the Commodities team this coming Monday, 9th of March at 1 o'clock London time. That's 9 a.m. New York. I will add a registration link for clients to join that drop-in. But again, do get in touch at podcast@capitaleconomics.com if you are not yet a client and want to join the briefing. We will be back next week with more from the world of macro and markets, including the latest on this conflict and its broader implications. But until then, goodbye.